world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. We've seen an evolution in fintech since the early days, transitioning from disruptors and disintermediators to partners and platforms. Where do we go from here? Tim Levene is the founder and CEO of Augmentum, a fintech venture capital firm. Prior to starting Augmentum, Tim worked for Bain, started London restaurant chain Crussh, and founded Flutter.com, which merged into Betfair in 2001, at the beginning of the latter's meteoric rise to prominence. Augmentum has invested in companies including Zopa, Seedrs, Interactive Investor, Tide, DueDil, and more. Tim brings experienced and informed views to this conversation and chats through his expectations for where fintech goes from here. What's in store for the space in 2019? Let us know on Twitter @Rebank Podcast. If you like today's episode, please take a second to rate us on iTunes. Thank you very much for joining us today. Please welcome Tim Levene. Tim Levene, welcome to Rebank.
Thank you very much. Good to be here.
So it's good to connect with you. We've had a number of London-based VCs on the podcast before, and we've chatted through some pretty interesting topics. I think it's actually been a while now since we've had a good one-on-one with a kind of man on the front lines making investment decisions in fintech. So I thought it might be interesting to kind of kick off the new year thinking a bit about how you guys have built the portfolio that you have, what the driving investment thesis has been, and then as you kind of look forward. Both with the macroeconomic climate being what it is, and where it might feel like we are in terms of independent, standalone fintech plays versus consolidation, the strategic partnerships, where we see fintech going from here. Maybe just to kick things off, quick intro for context on you guys and the fund.
Well, we are definitely now Augmentum 2.0. Augmentum 1.0 kicked off in 2010. And what was interesting when we started on this journey looking at financial services and ultimately its disintermediation, my background at Betfair back in the late 90s, when really the business was really kicking off, we saw a huge opportunity in the betting industry, particularly in the UK, where we felt ultimately it could be a global leader, significant regulatory challenges in the US. And we watched the industry evolve and roll forward 10 years, having been a part of that journey and seen Betfair become one of the first, what is now called a unicorn, and is today a FTSE 100 business. I think in 2010 we saw a lot of similarities in the financial services industry than we saw in the betting industry, but on a scale 1,000x the size. It had been slow to disrupt for good reason, but obviously the financial crisis in 2008 was a significant catalyst for that. And having moved back to the UK, having spent several years in Asia, for me the opportunity was obvious. The challenge I had was, how does somebody with no financial services experience, with no investment experience, look to tackle that? Obviously, I'd had no betting industry experience. I felt that there was some track record there. Having approached Lord Rothschild and RIT Capital back in '99, when we were fundraising for a business called Flutter, which merged with Betfair, they didn't invest, but I built a relationship with Lord Rothschild, and I went back to see him a decade later and told him a similar story about financial services that I told to the betting industry back in '99. And so really that was my first foray. I was lucky enough to get back with some capital by RIT. I spent several years working with them, and they were really the sole LP in the fund that I created, which was branded Augmentum, and we really cut our teeth on a number of investments. I think our thesis was strong, but it really, in 2010, when we made our first investment, it hadn't yet to be proven out. And I think the challenge for us was, one, demonstrating to the market that we were credible investors, and there were a significant number of VCs in the market, even more so today, but there was a lack of entrepreneurial DNA running through venture back in 2010. I think that's been transformed. I think roll forward to 2018, when we sat there and said, we've deployed our capital, we've done some good investments, we've made some mistakes, we've learned a lot along the way, but ultimately we've come out of this with a good enough track record to go and raise our next fund. The question for us was, there are a huge number of VCs relative to where we were in 2010. There are a lot of subscale VCs. We were one of them. How do we differentiate ourselves in this market? And one, being specialized certainly differentiates you. But the opportunity to list and be the only listed fintech fund in the UK, and one of the only globally, really was a compelling proposition. And so our ambition was, one, of differentiation, and two, to really work off what we'd learned over the previous 7 or 8 years, continue to invest in those companies that were still in the portfolio and were still growing, but also really leverage that learning and back the next generation of what we regard are really exciting and interesting fintechs.
Yeah, great. So I want to come back to the the point around listing the fund and kind of talk through that a little bit, but so I think some of the earlier investments were the likes of Zopa and Seedrs and Monies, maybe some others that you'll know better than I. And you've continued with investment companies like DueDil, which in my mind kind of represent the first wave of UK fintech, and I think they were largely founded on the premise of either disintermediate, and this industry is going to go the way of Kodak, which is, I think, a thesis that we've largely moved on from, or respecting the existing financial services taxonomy in terms of what types of businesses do what products look like, how customers are segmented, build companies using technology that are much more efficient to operate than traditional businesses, traditional FS companies, and some of those businesses have been quite successful. I'd be interested to hear a bit from you about kind of looking forward, the way you expect the fintech, financial services innovation opportunity to evolve. Will it be more businesses with those two approaches? Will it be more horizontal plays that kind of touch various parts of the industry? Will it be more consolidation or kind of JV type work with incumbent firms? I don't know, and maybe more broadly your investment thesis kind of going forward.
Yeah, I mean, I don't think there's one size fits all in this industry. It's such a huge industry. I think we're going to see a continued evolution of the models. When we first started really looking at this as a thesis, everyone was talking about the unbundling of a bank. And we're starting to see, in some cases, a rebundling, the Revoluts, the N26s, that are looking to offer, full set of services. So, there's no question that different models are going to have different elements of success, and certainly there's not going to be one model that wins out. I think what a lot of fintechs underestimated was the challenge of customer acquisition and the cost of that customer acquisition. So if we look at the amount of capital that has been deployed over the last 6 or 7 years, those businesses that haven't quite made it, in many cases, those B2C businesses really did underestimate the stickiness of that customer. And despite the fact that there were deep levels of dissatisfaction amongst many customers in financial services, still this inertia to switching took a lot of people by surprise. And if you, depending on which stats you read and believe, building a financial services brand, a new financial services brand, takes 2-3 times as much time and often as much marketing capital as perhaps a proposition in another sector. I think for us, it's not about identifying exactly what's going to happen in the future. There are several verticals that we think are categorically ripe for disruption, but perhaps aren't the right fit for our type of fund, for venture. And you can look at a number of propositions in the asset and wealth management space where it is clear to us that margins will come down. There are some players out there that have operated on very fat margins, poor customer service, low-tech solutions over the years and are ripe for disruption. But these are going to be very capital-intensive propositions ultimately to succeed. And I think you can look at kind of the wealth management robo-advisory space as one good example that arguably is a compelling proposition, but not something that traditional venture funds might want to play in. So I think, for us, we're very conscious of the challenges of building a B2C proposition. We historically and going forward will continue to focus on the banking space and all the verticals that run underneath that. We are not the only one to be looking at insurance. And if I look at our portfolio of 15 companies to date, we are yet to tackle what is now called InsurTech. We've looked at over 80 quite closely. So it's fair to say we have a number on the watch list, on the radar. We like the teams, we like the propositions. However, they're not yet fully cooked from our perspective to take the plunge. All those that we have liked, pricing has got away from us. But certainly insurance is an area where we see inevitable and continued disruption. I think the big question there is who wins, who plays in that space. And already we are seeing more collaboration with traditional incumbents, which we didn't see, certainly in the early days with the banks. But we are seeing a shift there. There's no question that there is the start of more collaboration by traditional incumbent banks. We saw it yesterday with announcement, market invoices round. Both Barclays and Santander have invested. That's a deal that was very unlikely to happen 5 years ago, and I think we'll continue to see more of that. So I think, if we were going to put the headlines, where does Augmentum focus? At the very highest level, it's banking, insurance, asset and wealth management. And then as we go around the edges, those propositions that often service either the fintechs, traditional financial institutions, or a combination of both. So, whether it's looking at KYC, propositions such as DueDil, which is starting to, really, it really has evolved its model over recent years, and that's been a recent investment for us. They were one of the older fintechs, but having evolved their model, moved very much more to an enterprise proposition for us. That is a business that has found its product market fit, and we felt, the opportunity for them is now. It just took them a little longer to get to that point.
So maybe we can kind of roll back to the point that we touched on before, which was around the listing of the fund. I think we're probably all familiar with UCITS and listed funds kind of from that traditional investment standpoint, but it'd be interesting to hear from you from a venture standpoint, apart from differentiation, what the motivations were and the implications of listing the fund have been.
So I think the challenge we had with listing the fund was it's very unusual. There are very few listed traditional venture funds in Europe, and I would say most of my peers in the venture space suggested that I was a little bit crazy to be considering going to the public markets. Differentiation was a big motivator, but it wasn't the sole and the key motivator. I think we had two key motivations. One, the aspect of permanent capital. There's no question that companies are staying private for longer, and traditional venture funds operate around a 10-year life cycle. The investment period is 3 to 4 years, and you spend the next 3 to 4 years looking to harvest, and then the fund winds up. If you see that private companies are now staying private on average for 14 years rather than 7 years, actually that traditional venture model doesn't work in every situation, and arguably financial services businesses take that a little bit longer as well. So the ability to have patient capital, not to be forced to be looking at realizations, was really important for us. It doesn't mean that we want to sit there and hold on to our businesses ad infinitum, but just having that flexibility. If they're continuing to perform and continuing to grow, why should we be forced to look for realization? And two, access to capital. We wanted to open up the opportunity for institutional investors who don't have access to venture, who read a lot about fintech, and their exposure to it is nil. Their exposure to it really ultimately comes when a business comes to listing, and their view is perhaps a lot of those businesses are fully cooked and they've missed the trajectory on the upside, and they want to get access earlier. And to provide a platform where you can give not just institutional investors who only invest in the public markets, but retail investors as well. Retail investors have, and are continuing to show a strong affinity to a lot of these, consumer fintechs, and they want the opportunity to be able to invest in them. And I think for us to be able to offer both retail and institutional investors that are more comfortable in the public markets and don't have the opportunity to get exposure to early stage venture businesses. We thought from our point of view that was compelling. It's definitely, you can call it democratizing access to venture capital, which perhaps in the past has been exclusively limited to large endowments, family offices, those who can get access to the very best funds. And so we have opened the door to a new set of investors, many of whom have always wanted to get exposure to this asset class, but up until now have not had the ability to do so. So that was really kind of compelling for us. Not only that, the time period, the average emerging manager in venture is taking between 18 and 24 months to raise a new fund. And to put it bluntly, we took 2 months. We started January the 8th was our first meeting, 2018, and we listed on March the 13th, 2018, so just over 2 months. It's a grueling roadshow. It's unpredictable, and we very much took it to the wire in terms of were we going to get to our minimum, but we got over the line, and now we have the platform ultimately to really build on. So we have the capital, we have to deploy that effectively, and we expect to do that over the next few months. We should be what we define as largely fully invested by the end of this quarter. And ultimately for us, it's going back to the market, demonstrating, one, that we invested the first tranche of capital effectively, that our investors and prospective investors are excited about what we're building, and look to raise further capital going forward as well.
I'd be interested to get your thoughts. You kind of mentioned your understanding of B2C models, and certainly having invested in both the DueDils of the world, an enterprise play as you described it, and the Seedrs and some others, even some recent ones. What are your thoughts generally on B2C versus B2B? Do you have a preference or particular view in terms of one model versus the other?
Well, I think historically B2C was our bread and butter, and that was my bias, purely because having been part of the Betfair story from the beginning, we really understood and learned a huge amount on that journey, building a customer base from zero to several million customers. So I think the first key learning for us, as I mentioned earlier in financial services, was really making sure you understand the unit economics of these B2C businesses. And it certainly was a pitfall for us in certain investments where we hadn't quite appreciated the complexity and the cost and the time it's taking, and many others as well. So it was inevitable and the right decision for us when we launched the listed fund to look more closely at B2B, to understand that area far better. We brought in some expertise into the team that had much deeper expertise than myself, who really kind of understood the dynamics of what it takes to build an enterprise business. And if you ask those B2B specialist investors, there is greater certainty of the outcome, if not always the upside case isn't as great as those B2C propositions. So I think from our point of view, we recognize that we needed to look beyond pure B2C businesses, and increasingly we're seeing businesses pivot from B2C to B2B2C. And a good example of that would be in the robo space, where you had a number of aspiring robo advisors that simply found it too hard to build significant customer base and assets. But in some cases, they had very impressive, back-end systems, and working with incumbents, was a sensible decision. So, no question. If I look at our portfolio, we're still biased towards B2C. However, we'll continue to look at B2B. We've done 3. We're looking to do 1 or 2 others as we fill out the portfolio as well. I think ultimately, though, you need to have a team that really understand both B2B and B2C if you want to invest in that area.
When you think about your experience, growing that multi-million customer base at Betfair, what lessons did you take from that? And what similarities and differences do you see with the fintech space?
Well, I think the difference back in 2000, April 2000, when we had our first customer, was the internet was very much Internet 1.0. We were on our journey, and it was a very, very different proposition to what we find today. I was talking to someone last week, and I was talking about the click-through rates on banners. And I was saying we used to get over 1 to 1.5% click-through on a banner, and then a conversion of between 1 and 2%. Now, you talk to people about banners, they laugh. So, it is a very different customer acquisition journey. So, I think for us, what we really learnt there back in 2000, 2001 was the importance of understanding, 1, your channel economics, and 2, your payback time as well. I think the ex-Bain consultant in me kind of never leaves you, and being very analytical has always stayed with me, and I think it kind of cuts through the team here as well. And I think what is incredibly important in areas where perhaps we've not focused, are businesses that have built very significant customer bases, where the business model is not perhaps as clear. Ultimately, we'll build the customer base and worry about the unit economics later. I think for us, that's been an area where we felt more uncomfortable.
I notice you haven't invested in any digital banks.
Well, we have in a business such as Moneys. But what we haven't invested in is in perhaps the most capital intensive
banks with a capital B.
Yes, and I think exactly the point I just made. That has been our challenge. Not that we don't believe that there'll be 1 or 2 digital challenger banks that ultimately become significant brands. I think there'll be a number of casualties as well along the way. But is that a traditional venture investment? If these are propositions that to get to day 0, they need 100, 150 million pounds of capital. Once you get the reg cap, you've built the platform, you've built the first kind of marketing proposition. Our view is we'd be so minuscule in terms of position, and have we really de-risked the proposition? So I think from our point of view, it's not saying we don't believe in these new age digital banks that are capital intensive, and obviously Monzo's a good example of that. It's from our perspective, is that the best use of our capital? Does that fit our strategy? And looking at Moneys as an example, why were we compelled to invest and back that team? They were offering a proposition that nobody else was offering, and they had customers that were prepared to pay for a current account. We always say, it's very hard to make money out of current accounts. Well, if you're getting customers actually paying for them, then it's a very different model. By offering those expats and kind of immigrants the opportunity to open a bank account immediately, where they could get paid their salary was, incredibly important for them. And the vast majority of their customers use monies as their bank account. They deposit their salaries in it, and the percentages of customers that deposit salaries is on a multiple of perhaps any of the other more traditional digital banks that are out there as well.
What other lessons did you take from the Betfair experience that you apply now as an investor? And I don't know, maybe it's advice that you give to founders that you work with.
Well, there's a number of learnings along the way. I think we were lucky. Certainly, myself at Betfair, we were growing at such an extraordinary rate, and the whole digital space was growing at an extraordinary rate that, despite the many mistakes we were making along the way, hypergrowth masks great inefficiency. And I think it was a unique period where you could learn along the way, and not have too many dramatic pitfalls that would ultimately kill the business, or certainly kill an initiative that you're working on. I think we're in a much less forgiving environment now, and we have a lot more talent in the market where people have gone through that journey, and can apply those learnings. I think for me, one of the key takeaways is when you are part of a business that's growing at the rate, certainly that Betfair was back in the day, you're continuing needing to stretch yourself and reinvent yourself if you're going to be the right person for the next phase of that journey. And I think it became clear to me at one point, once Betfair got to a certain size, that actually my capability, I was overstretched. I didn't have the experience to be part of a business that was ultimately grew to 2,500 people, and it's a very different skill set that you need. I want to be at the coalface. I want to be helping building these businesses, not spending the bulk of my time focusing on structure and team meetings and all that comes with that. So in all of our companies, as they go on this growth journey, it's very challenging for the founding team to look at themselves to say, am I the right person for the next 2 years? I've done an extraordinary job for the last 2 years. And also look at the team that they're working with, and be honest with themselves to say, is this individual going to be able to continue to grow, or have they in some cases outgrown the business? And I think managing people, allowing that talent to evolve is one of the critical success factors to a lot of these businesses. It is very unusual to find a management team that pretty much has stayed in place the whole way through. And it's the same for the founders as well. They always need to look at the business wearing their shareholder hat, not as an executive. And it's hard to be objective when you're in the weeds every day, working the extraordinary hours that many of them do.
Yeah. So to wrap up, I'd be interested in getting your thoughts around maybe fintech sectors that seem most fintech and kind of tangential, perhaps, that seem most ripe for opportunity going forward.
So I think we're still super early in the journey. I'd argue that we're at the end of the beginning now, and over the next 2 to 3 years, we're going to see some very significant businesses built, especially in sectors that perhaps some think are already heavily disrupted. But even if you look at the lending space, even if you look at a business such as Zopa that has grown 20x over the past 5 years, it's still just 2% of the consumer lending market. And so there is a long way still to go in a lot of these perceived developed fintech markets. I think there'll be consolidation. I think there'll be, we'll see the start of some significant acquisitions from incumbents as well. I absolutely believe that we're going to see some very significant insurtech businesses start to being built. As of yet, there isn't a breakout leader in the space, but I'd be surprised in 2 to 3 years if we don't see one of those in Europe. I think one of the areas we have to be careful on is allowing areas to get overhyped, and then there is a rush of capital to that space. Obviously, we've seen a huge amount focus on blockchain. We've seen a significant amount of capital go into the crypto space as well. At the moment, open banking is very relevant. There is a lot of capital going in there. The question is not, is it going to be effective? The question is how long, and what are the types of businesses that are going to be built. So I think our job as an investor is not only to spot the trends, but also to get our timing right as well, and not always to follow the crowd. Sometimes we've got to be prepared to be contrarian, and we certainly have in the past. We've done and made investments in businesses that perhaps weren't obvious, in some tired businesses. When we invested in Zopa in 2012, an interactive investor in 2014, the view was these were businesses that weren't going to make it, and we look at them today, and Zopa has a loan book of £3.5 billion. Interactive Investor now has an asset pool of 35 billion, is number 2 in the UK direct-to-consumer space. So it's not always the most obvious propositions where you should deploy your capital. And I think we need to continue to be patient, because I think we're a believer that over the next 5 to 10 years, there's going to be very significant continued growth and disruption in this space. And we're very excited to be a key part of that journey.
Excellent. Tim, where can people find out more about Augmentum and your portfolio companies?
So the most simple way is to go to augmentum.vc. We are on Twitter. We're on LinkedIn. You can contact the team, info@augmentum.vc, if you have any fintech propositions that you'd like us to take a look at.
Excellent. Tim Levene, thank you very much for joining us today.
Thank you for your time.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter @Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.